Datavault. When a stock goes from 25 cents to over $4 almost instantly, people assume a new bull market is starting. But not every massive rally is the beginning of a long-term uptrend. Some are the final head fakes of a multi-year decline. Today, let's find out which one Datavault really is. Let's start by analyzing the chart. Datavault has spent nearly its entire public life in a long-term downtrend, starting shortly after its 2017 IPO. Every rally attempt over the last 7 years has eventually failed, and the decline from $18 in January 2024 down to 25 cents on September 24th, 2025 was just the continuation of that structural weakness. After bottoming at 25 cents, DVLT launched a sharp rally that pushed the stock to a local high of $4.10 on October 27th. The size of the move is significant, but the real question is whether this signals a genuine change in trend or just another abnormal spike inside a multi-year decline. For context, DVLT hasn't traded in the $4 range since April 2024. This time, however, the rally came alongside massive volume, enough to turn over the float several times. Leading into this rally, the price spikes came on heavy volume, and the pullbacks in early and mid-October saw contracting volume, suggesting that sellers may have temporarily exhausted their supply. The second leg of the rally in late October also showed volume expansion, and the contraction through late October and November again came with lighter selling pressure. The most recent spike this past Friday was accompanied by another strong increase in volume. And here's the key point. The cumulative volume during the rally was several times larger than the float. Because the float was turned over multiple times during the rally, overhead supply probably isn't relevant anymore. Most holders who wanted out had more than enough opportunity to exit. Even with the strong volume characteristics, it is still too early to call this a confirmed transition into a stage 2 uptrend. DVLT did not form a proper stage 1 base. Normally, after a stock bottoms, it needs a prolonged period of sideways consolidation. Instead, DVLT bottomed at 25 cents and immediately launched into a rally. That's abnormal behavior and exactly why caution is still warranted. For DVLT to confirm a legitimate new uptrend, it must rally back towards $4.10, break above it decisively, and do so on expanding volume. Without that, the stock remains an early, unproven reversal attempt inside a long-term downtrend. Before taking a long position in any stock, you always want to check the trend of the overall market. You want the force of the market behind you, and you want to avoid buying right at a market top or during the early stages of a correction. To do this, we use the concept of distribution day counting, championed by William O'Neill, the founder of the CAN-SLIM method. A distribution day occurs when the index declines at least 0.2% and volume that day comes in higher than the prior session. This signals institutional selling, and when these days start to cluster, it tells you the big money is pulling back. Historically, 6 or more distribution days within a rolling 25-day window is a warning sign that the market may be topping or heading into a correction. Right now, the S&P sits at 5 distribution days. That's not a confirmed correction yet, but we are one heavy down day away from triggering a bear signal. However, there's also a key timing factor. If the market can avoid taking another distribution day until Wednesday, the oldest distribution day will fall outside the 25-day window. When that happens, the count automatically drops back down to 4. So the market is in a tight binary setup. One more heavy down day, we get the bear signal. 2 stable sessions, the pressure resets and the count drops to 4. Either way, this is a moment to stay alert and be selective with new long positions, especially in volatile small cap names like DVLT. Now let's take a quick look at the fundamentals, because price action can only take you so far. At the end of the day, true market leaders have both strong charts and strong financials working together. With Datavault, the first thing that stands out is scale. Even though revenues have recovered from their 2021 levels and are now showing sharp acceleration, Datavault still isn't even bringing in $10 million a year in revenue. This is a micro-cap company with nano-sized financials. Gross profit has only recently turned positive for the first time, and even then, it's still under $1 million. Meanwhile, the company has been bleeding operating losses for its entire history as a public business. These are not the fundamentals we look for in the next market leader. In true leadership stocks, you want positive operating profits, positive pre-tax profits that are both growing and accelerating, all backed by strong, expanding revenues. And Datavault does not fit that profile today. That doesn't mean the stock can't move on speculation or momentum, but fundamentally, it's not in the category of companies that institutions typically accumulate during major market cycles. Over the last weeks, Datavault AI has been in the headlines, more so than we've seen in years. On November 17th, they announced a major agreement with Triton Geothermal LLC, a tokenization services deal valued at up to $8 million, plus ongoing participation in transaction fees from a projected $125 million digital offering. Just days later, on November 24th, Datavault disclosed a $7 million minting licensing deal with Tanzania-based MTB Mining Ltd, plus a 30% perpetual royalty to digitize over 25 million metric tons of copper reserves and gemstones using its Sumerian tech. They also released commentary updating the market that their 2025 revenue guidance has increased towards a lower end target of $30 million, and they're projecting $200 million in revenue for 2026, based on the RWA, real world assets model. So on the surface, it's a bold pivot. Datavault is moving from tiny historical revenues into high-stakes tokenization and asset digitization deals. But remember, while the contracts are headline-worthy, real recurring revenue, profitability, and institutional validation are still far off. In other words, the chart is interesting, the fundamentals haven't yet caught up.